So as we come to the close of 2017, we're really marking the 9th year of very strong equity market returns. Over the last 9 years, we've seen the US equity market grow by about 240%, and we've seen the Australian equity market grow by about 140% over that same time. This has really been driven by central banks globally pouring tens of trillions of dollars into financial markets. And as a result, global interest rates are at historical lows. Even as we sit here today, there's about $8 trillion worth of global bonds which are trading on negative interest rates. What that means is that if you were to invest in one of those bonds, you would be paying the borrower to hold your money for a period of time. Because economic growth is relatively robust, we see that there's this early stages of some of these policies starting to normalise. The US has been raising interest rates now gradually over the last 12 or 18 months or so, and they'll continue to do that, we believe, into 2018. In addition, they have started to withdraw the amount of liquidity that they have added into the system. Markets over the last few years have become incredibly willing to take risk, because every time there's a slight hiccup, they're very, very confident that central banks are again going to step in and pour this liquidity in. So what that means is we're currently operating in a market environment where risk is almost being completely ignored. There was an interesting piece of work done recently by Deutsche Bank, which spent some time looking at financial crises or market volatility over the last 30 years. Now, there are a couple of key things from that. First of all, the landscape is littered with market events that led to really strong bouts of market volatility and large drop in risk assets. But the second conclusion was the fact that none of these events were really having an identifiable catalyst leading into them. And so that's where we sit today in assessing the market that we're sitting in, where risk is very, very subdued and people's willingness to take risk is very, very high. So in terms of what this means for portfolios, despite this strong equity rally in recent years, we've really seen a couple of dynamics going on underneath the surface. In 2015, our equity market portfolio investments contributed very, very well, given we held an almost exclusive position in industrials, avoiding what we saw with the downside as occurred in 2015 to resource and cyclical businesses. However, 2016 and 2017 saw a very anomalous period. It's almost a very unique period we've seen over decades, where there was almost an exclusively very sharp rally in these resource and highly cyclical businesses, which resulted in very strong returns in certain components of the market, whereas our more stable, predictable investments in equity markets generated much smaller returns. As we sit today though, we've seen that cyclical rally roll off, and ultimately the portfolios have started to generate strong positive returns again. The growth portfolios, for example, are up over 6% in the last 3 months alone. So as we enter 2018, there's probably two key things I want to highlight. First of all, we've continued to take small amounts of equity risk off the table. We've benefited very materially from our equity holdings now for many years. We're just very conscious that market valuations are very, very full. What that means is going forward, unquestionably returns are going to be lower than what they've been in recent years from the equity market. Therefore, we want to have liquidity in the portfolio to be able to exploit any volatility as and when it comes along and be able to reallocate that capital at more attractive prices. In addition, we continue to prefer offshore assets, international assets to domestic, and that's something that's a position we've held for a number of years, and the portfolios have benefited very, very materially from that, given the material outperformance that we've experienced in global investment markets compared to local investment markets. And that continues to be as a result of some of the structural headwinds we think Australia is facing as China continues to slow and the Australian economy repositions itself away from a resource-led, export-based economy. My final point really is the importance, in our view, of active asset allocation and active investment selection in the market environment that we sit in. Ultimately, over the next few years, we're going to see the normalisation of interest rates, we're going to see these tens of trillions of dollars of liquidity that have been pumped into the financial system being removed, and we're going to see that has a range of implications for financial markets. But in addition to that, we find ourselves in an environment which is almost akin in many ways to the Industrial Revolution a couple of hundred years ago. The change that's going on within sectors and economies through the Internet of Things, automation, the increased utilisation of artificial intelligence, driverless cars, etc., is going to have manifest changes in terms of how businesses, sectors and economies operate. And ultimately, we're very concerned when we have discussions with people who are wanting to take a passive approach, just call it a set and forget approach, that's going to leave them at risk to being exposed to investments that a few years ago might have been good, but the advent and the speed of these changes are going to result in material potential downside risks that are coming about that need to be actively managed. So as these changes and issues roll out, we want to remain active in preserving your capital and continue to find and allocate to opportunities that we have confidence will compound your capital well over time.